call up, let's look into call options. All right, so let's look at the call option definition. A call option is a contract between a buyer and a seller to exchange a stock at a predetermined price. Predetermined price is the premium and date. The date is going to be the expiration date. The buyer has the right but not the obligation to buy a stock at the predetermined price and date. The seller has the obligation to sell the stock to the buyer if the buyer decides to exercise that option. All right, let's look at some quick talking points about this definition. Here we go. Bottom line, the buyer of a call option believes that the price of the option is going up. He has the right to buy that stock if he chooses to do so. The seller believes that the price of the option is going to go down. Bottom line, the seller has an obligation to sell that stock if the buyer decides to exercise. All right, let's take a look at a real world example of this. All right, let's take a look at Workhorse. Workhorse on the 20th of January, time that I captured this, it was at $23.29. It went down 47 cents, which represents a 2% decrease in the value of that stock. Now, if we take a look at the call options chain for the 19th of March, 19th of March is realistically about 2 months down the line. So let's take a look at the options chain for the call option for Workhorse. We're going to go about 2 months down the line. We're going to take a look at March 19th expiration date. We're going to look at the strike price of 24 bucks. If you notice, the premiums for that is $4.15 per share. Per contract, that's 415 bucks. That's what the buyer has to pay. That's what the seller is going to receive. If you also notice that the price of that option went down 35 cents. That 35 cents represents an 8% decrease in the value of that option, where the stock only represents a 2% decrease in the value of the stock. It goes to show you that a small movement of the stock is magnified in the price of the option, either way, up or down. All right, let's take a look at everything from the buyer and the seller's perspective. All right, okay. The buyer's pros and cons when it comes to a transaction like this here. All right, we're still going to use Workhorse 19 March strike price with that $4.15 per share premium of 415 bucks. The pros for the buyer: unlimited upside potential. Let's just say that Workhorse goes from 23, whatever it was, to $34 by the 19th of March. The value of that option is actually going to increase to over 10. It's going to be about 10. All right. So he paid 415 bucks. Now it's worth $1,000. That's what I mean by unlimited upside potential. Limited loss. He paid 415 bucks. That's the maximum amount that he can lose on this trade. Better leverage. All right. If it closes at 34, he gets $1,000 if he decides to go ahead and just sell the option. And you're looking at what, $585 return on investment? That's well over 100%. All right, less capital needed, 415 bucks, compared to the owner of the stock who paid a lot more than 415 bucks. Possibly he can buy it at a discount. Now, if it shoots up $34 by the 19th, that call option price is going to be $10, at least $10. He has one or two choices. He either can sell the option and take the difference, or he can exercise his right to buy the stock at $24, even though it's at $34. The cons: limited time. Bottom line, every day that the stock does not move in the direction that the buyer wants, he's more than likely increases his chances of that option expiring worthless. Not eligible for dividends. Workhorse doesn't give dividends. However, if he had a stock that had dividends, he would not be eligible for it. That goes to the seller. One way to profit. That basically means the stock has to go above $24 per share. Now, let's turn our attention now to the seller. All right, the sellers, the pros and cons for the seller. The pros, 2 ways for the seller to profit. All right, if the stock stays the same at 24, the seller wins. If it goes down below 24, the seller wins. All right, so keep that in mind. It's an income generator. The seller is going to receive that $415 regardless of what happens. He keeps that premium. Time is on the side of the seller, but not on the side of the buyer. If by chance a stock pays dividends, the seller is going to receive the dividends because he's the owner of the stock. This technique of selling call options is the seller has a higher probability of success than the buyer. The cons, limited profit. His profit is capped at the strike price. Most he can get if the buyer decides to exercise is $24 per share. Unlimited loss. He still owns the stock. If the stock goes to zeros, that's the loss on the seller, not the buyer. Now we've had the opportunity to take a look at call options. The very next video is going to deal with put options. But I need you guys to do me a favor. Always remember that results happen over time, not overnight. Work hard, stay consistent, and be patient. And always remember that knowledge is not power, it's the application of knowledge is power. See you guys on the next video.